Well, it's been some years since a Bank of Japan meeting held the propensity for volatility across markets, but this meeting this week on Wednesday holds it in spades. Importantly, the market is betting on big movement in the Japanese yen and the pairs, the JGB complex, the Japanese equity market, and a potential broader spillover into G10FX. Stay tuned. I preview the meeting and why you need this on your risk radar. Good morning, traders. So all eyes on the Bank of Japan. It's now time to get set, look at your exposures, manage the risks. The position sizing that you have around this is absolutely essential because the market is on tenterhooks for a potential change to the YCC, or the yield curve control program, that's effectively capped long-end government bonds. And that's been in place since 2016. They recently changed that to cap government bonds at 50 basis points on 10s. They changed on the 20th of December. Now, the market is expecting massive movement as a result of these potential changes or lack of changes. If we have a look at the options market, we can see 1 week implied volatility in dollar yen trading at 23%. It's the highest level since March 2020. The market is effectively speculating that we could see a move up or down in dollar yen of about 350 pips over the coming week, about 70% probability around that. Of course, we could actually even see that off the bat, depending on the outcome there as well. Yen crosses the implied vols are sky high. We can have a look at in the rates market and see rates volatility at the highest level since the GFC effectively. So the market is expecting massive movement. Your job as a trader, of course, is to understand how that movement plays into your positions. Do you want to reduce? Do you want to exit? Or is there a skew in the outcome of distributions which suggests giving a confidence to actually take a position over this? It's pretty clear that YCC doesn't work. There's a dysfunctional market. They've changed recently and it still doesn't work. So something happens to change. The question is will it happen at this meeting or somewhere further down the line once Kuroda steps down? In terms of the possible scenarios, the first one which could cause a massive move would be if the Bank of Japan refrained from doing anything at all. Now, given that speculation last week in the Japanese press was that we were going to see the Bank of Japan making moves, and we saw dollar yen trading into 127. A refrain from doing anything at all would cause dollar yen probably to move up 200, 300 points off the bat, and markets would obviously do about turn from what is effectively a pretty long yen position from leveraged community. The other issue would be whether we see a complete abolishment of the yield curve control program. The market's speculating that we're going to see massive repatriation of capital back to Japan, in which case you could see the yen rally significantly, and you'd see that March, like the May lows of 126.30 coming under pressure. We could see that yield curve control cap being taken up to 1%. I think that's a real possibility that happens. There's a whole permutation of factors playing through, but the market's expecting massive movement, massive price action playing through. It's a risk for you. Put it on your radar and trade at Pepperstone.